topical. So let's shift gears maybe to term life insurance. And I want to start off by discussing how much should we get? Kristen, I've talked to a lot of people, and some people say, well, you're funding it through the corporation. It's a drop in the bucket. Who cares? Go for as much as you can, 10 times your income minimum. And for me, I always like to take a bit more of a structured and objective approach. So maybe you can give us a bit of a roadmap on if we're opting for term life, how much should we be going for? What factors do we need to take into account?
It's a good question. It's such a weird product, right? Because you're just selling
Yeah.
the unknown. You're selling this
Yeah.
guesstimate. Like it's very difficult. You're not buying a thing, right? And so it's very hard to pinpoint that number, and that number is different for everybody. A part of that factor is your risk aversion, right? Like if you're very risk averse and you're very nervous, you're going to buy a lot more insurance than somebody who's like, you know what? Let's play the odds. Let's sort of build up that cash flow on my own. But
Hmm.
one of the big things I always say to people is obviously the younger you are, the more coverage you're going to need. So when you're starting off your term insurance journey, ironically nowadays, I don't think I've sold less than $1 million of coverage because that's just sort of the cost of life right now, even without having children or having, a partner. If you buy your first home, your
Hmm.
mortgage is likely in and around $1 million or right around that point, right? So
Yeah.
when you're starting out younger, you kind of need to start building that. And the likelihood
Hmm.
is the as your career progresses, your lifestyle progresses, you're going to need more. So it's always nice to sort of cushion yourself when you're younger to get much more term insurance and sort of make sure that it's robust right off the bat. But when you're thinking about it for somebody perhaps mid-career, where they have some of that financial dependence, where they have sort of that family life that they're protecting as well, what I kind of look at is this kind of idea of using capital. And so funny enough, I maybe it sounds like I love disability because I do, but I kind of tie it back to disability. And I think to myself, okay, if you need $15,000 a month to support yourself if you were disabled, I
Hmm.
kind of transition that into a life insurance need as well. You likely will need $15,000 to support your family unit without you there.
Hmm.
And so what we want to do is we want to project out that number and kind of get that pool of money that to say, okay, when we draw down that 15,000 a month to keep our lifestyle as is, this pool is still going to be there to support whoever I'm leaving behind until they no
Hmm.
longer need that support. And so it's kind of makes it a little bit easier to look at, to sort of think out, not so much like, take your income times 1,000, divide by two. It's not so much of a math equation as much as it is looking at your needs and looking at
Hmm.
things like, what are my day-to-day expenses right now, like your utilities, your mortgage payments, any debt that you're carrying that you have to pay off that you'd be leaving in your absence to somebody else to manage. Talking about, yes, replacing your income, but what does your income do for you? It saves for retirement. It hits those future financial goals. What does that look like without your income?
Hmm.
Children, like what does their education system look like? Do you want to be supporting them through that? And so that's where we sort of get that monthly figure of 15,000, 10,000, whatever that number is, and then can project out. Again, being younger, you're going to need more. And that can
Yeah.
kind of dwindle off as you get older. When children aren't as dependent, you're financially more dependent for yourselves. And you can start looking at perhaps permanent insurance where you're leaving more of
Hmm.
that legacy framing kind of idea and drifting away from that term. One thing that I always think is really important too when you're looking at term, a lot of people will say, okay, but I already have a house that I have paid and I have RSPs that I have saved and I have TFSAs and I have all of this. When you are looking at that to
Hmm.
reduce the amount of insurance that you need, start by looking at what is liquid. Because what you want to be
Hmm.
doing is to say, I have a $500,000 in my RSPs, I don't need life insurance. You don't want your partner or your family to have to get the tax bill and the burden of pulling out an RSP to
Right.
support their lifestyle in the immediate. So as much as those do support you, we want to
Hmm.
look at just the liquid things like TFSAs, like things that are in cash. We don't want your family to have to sell the house to continue their lifestyle. We want to
Right.
maintain status quo. So when you're looking at what assets you have to reduce the amount of life insurance that you need, look at it from the perspective of cash, liquid, usable assets that you could technically liquidate and use for your lifestyle, not everything.
Okay.